Good morning and welcome back to Almus Market Mornings. There's a packed macro backdrop to start the day. President Trump's tax bill has cleared the House, setting up for a crucial Senate vote that could raise the debt ceiling by approximately $4 trillion and add pressure to the bond markets already grappling with the rising yields. At the G7, finance leaders pledged to address global imbalances, a message which is widely viewed as directed at China, even as the final communique avoided naming names. Meanwhile, speculation of a coordinated move to weaken the dollar was firmly denied by the US officials, reaffirming a strong dollar stance. JK, how are you reading the bond market's reaction to the budget bill, and what do you think? What do you think of the messaging from the G7 and the White House?
Good morning, Sharaj. Yeah, passage of the budget bill by the House, of course, to be confirmed by Senate further, is only fulfilling political agenda of President Trump, where during the election he had promised deep tax cuts, and this is what the bill proposes a lot. There is no significant reduction in spending. In fact, the allocation for military is actually being increased, contrary to earlier indications that they would be cutting expenditure on defense. This is not good from the economic point of view or from the market's point of view, because it's likely to increase the debt by nearly 4 trillion in the coming years, and the deficit is also likely to be higher because the interest payments are going to be higher. And so the impact is that, who knows, in future you may have to actually increase the taxes if you have to balance the budget, or at least coming closer to balancing the budget. It reduces the discretionary spending, scope for discretionary spending by the government, because the balance is already quite tight, and of course interest payments will be higher because of higher yields. Uh, Markets have taken rather, the bond market has taken the passage of the bill a bit calmly. We have the bond market yield hit a new high, but then came off. It's more on a profit-taking basis, but they hold well above the recent resistance, or key resistances, at 5% for 30-year and 4.50% for the 10-year, and the path of least resistance for the yields is higher. So we can expect more, selling of bonds in the coming days. As I said earlier, the yesterday UK inflation was higher. Today, data from Japan shows the core inflation has once again increased there, and at 3.6%, 3.5%, and that is not a good news, because Japanese bonds were already, under pressure. So this will be another point of pressure for the bond market. I don't see this passage of the bill as any positive for the market. Yesterday, we did have some data from US. In fact, PMI surveys from across the regions. US surveys actually stood out by improving from April, and whereas in other regions like Europe and the UK, actually it reduced. But that did not see any major reaction from the dollar. In fact, the jobless claims also came lower, but the reaction from the dollar was very muted. Not even the bond market and stock market reacted positively to it. So market's focus is mainly on the medium-term expectations for the U.S. economy, which is likely to face challenges due to higher tariffs and also higher deficit, as also the bond yields, which will eventually convert themselves into higher interest rates for mortgage loans and other sorts of loans that the people borrow. So it's market is not taken it any as any positive sign. We did have, of course, the dollar slightly go higher, more on a profit taking. Also, as a reaction to the Eurozone PMIs coming worse than expected. Uh, But the eurozone, rather the German ifo number was quite encouraging. Once again it went up, and the ifo official has said that the German economy is slowly finding its footing. So it's kind of mixed feeling as far as the eurozone economy is concerned. And UK, of course, has had a mixed picture. The GDP was higher, and then the inflation was also higher. So it's a lot of question mark on how the UK central bank will move on the rates. So overall picture is, US data does not reflect any major concerns as of now. But the expectation is that it will worsen in the coming months, and we are seeing some improvement in the other regions. So a dollar is, not likely to deviate from its weakening path. We'll have some corrections in between, which we are seeing right now in terms of time, not in terms of prices. We still are at the weaker end, and it could consolidate for some more time. As at the cost of repetition, I would say that dollar will consolidate for some more time, but eventually is likely to go down. Dollar index probably towards 95, euro probably towards 1.20, and GBP towards 140. The G7 communique obviously was followed a standard line, and even the US officials followed the standard line on wanting a strong currency. But if you look at the market reaction, that's not something that they believe, and market continues to sell the dollar. Precious metals also had a steep correction yesterday after having risen strongly in Asian time. It was again a case of profit taking, but they remain quite firm due to two reasons. One is geopolitical concerns until the Iran US deal stands as a question mark. If it fails, again there can be some concerns. And also on the fact that dollar diversification is eventually flowing into the metals also. So dollar weaker, metals stronger. So that's the theme. Yesterday we mentioned about the rupee being in a world of its own in a very narrow range, but we said it just at the time when it was changing, and we saw a big bump up in the USD INR after it broke 85, 75, and very quickly touched 86.10 mark also. This was on the back of two things. One is continued outflows, and possibly this is more possibly out of corporate, disinvestments from foreign investors, and then possibly some more defense-related buying and oil buying. All these contributed, and of course 85-75 break, which we were all through mentioning as a strong resistance, also led to some stop losses. So the quick move there, but I'm not seeing this as start of a sustained weaker rupee, based on the fact that dollar index itself is weak. We are seeing Asian currencies also gradually strengthening. Indian economy relatively doing much better, very stable. Higher growth, lower inflation. Growth-oriented approach by RBI. All these things favor the rupee. So I think this was an case of an accumulated outflows which weakened the rupee, and offers very good levels above 86 for exporters to hedge. So I'm not seeing much further weakness. And I also have to point out that at 86.10 and above, we have very strong technical resistance, which is where the 100-day moving average exists. And usually 100-day moving average is indicator prices staying below 100-day moving average means it's a downtrend. And currently we have been staying below it ever since we broke in March of this year. So technically and fundamentally, rupee points to regaining itself. And finally, I have to also mention that the RER of rupee is now, fairly valued, in the sense that it's almost close to 100. Almost from 108, we have fallen to around 100 levels. Any further weakness in the rupee will mean that rupee will get undervalued. So I feel for all these reasons that the rupee is more likely to gain from these levels and follow the overall dollar trend. Thank you.
Thank you, Jitin. Of course, this week was highlighted by the turmoil in the bond markets, the rising yields, and of course, the reason was one of the reasons in the US was the bill to increase spending, and there are some tax cuts and stuff like that, which is going to increase the spending and the deficit, which is making the bond markets nervous. When it comes to the other developments, we have the core inflation in Japan coming higher, which may keep the pressure on the bond markets in Japan. When it comes to other data, PMI surveys improved in the US, while in Europe and UK, the numbers were a bit weaker. That did not result in a major reaction from the markets. When it comes to rupee, we had a solid move over there. A break of 85.75 led to a sharp weakness, with the USD INR pair crossing above the rupees 86 mark. That's it from us today. Thanks for listening. Have a very good weekend. We'll catch up on Monday with the fresh round of updates. But Monday, JK, if I'm not wrong, it's a dollar holiday, right?
It's a holiday, yes.
So,
But our domestic market will be open. We will cover briefly on that day.
yes, yes,
Yeah.
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 Okay.
Okay.
So the outflows
Thank,
on Monday
thank.
would not be there, but
Will
otherwise
not be
the
there.
markets
Yes.
would be working.
Correct.
Yes.
You're right. Yeah.
Okay. Thanks
Okay.
for listening, everyone. Have a good weekend. We'll catch up on Monday with a fresh round of updates.